I'm all ears, please.
Even if media don't like to hear that very much. But I feel that central banks are now not so much in the driving seat. After the great financial crisis, it was all about central banks. They were really the rainmakers on financial markets. And I think that politics and politicians have made the big comeback, and that central bankers are now reacting to some of the political decisions that are being taken elsewhere.
Welcome to You're in Business. I'm thrilled to say that we're joined by Nanette Hechler-Feder, the Chief Investment Officer, EMEA at Lombard Odier. She joined after working at Credit Suisse for 24 years, where she was the CIO. Nanette, thanks for making it to the show.
Thank you, Youssef. A great pleasure to be here with you.
Let's start with the Swiss, because you have, of course, a finger on the pulse on the ground over there in Zurich. And they got a pretty decent deal when it comes to tariffs, right? So what's the conversation on the ground there at the moment? How confusing is the back and forth from the Trump administration for the Swiss?
Well, I think the Swiss have been playing whatever cards they had really, really well, especially by hosting the very important negotiations, or at least framework negotiations around the framework between the US and China. I think with that, they have positioned themselves in a way that is leading probably to a compromise. So the back and forth, I think, is what Swiss have been expecting from Donald Trump personally and the Trump administration. But relations with Scott Bessent have been constructive since the very beginning. And I think that in contrast to the European Monetary Union, obviously Switzerland has not received any letter. And so we are, I think, looking towards a good 1st August, which is National Day here in Switzerland.
I mean, the shock was pretty high from the Swiss side when Trump first said in April he's going to hit the country with 31% tariffs. Then that got delayed, then that got adjusted. So you would say the government has been quick enough to manage this new threat?
I think it has obviously had a little bit of a difficulty, because you may know that when it all started back then, there was also not yet the new U.S. ambassador in Switzerland. To just institutionally, there were some little hurdles and delays, but then I feel that it really got pace after the U.S.-China discussions that were hosted here in Switzerland. And from there on, there is not much noise. There is not much information coming through, but we are getting the sense definitely with the signals that have been given now with the issuance of letters and the absence of such for Switzerland, that we are, I think, on a constructive path here. So far, so good.
Now, where does that leave the inflation outlook then? Because, we keep hearing that we are in a period of structurally higher inflation. I was catching up with Jim Bianco, and he made exactly that point about the U.S. economy. I'm wondering to what extent this applies to Switzerland, to wider mainland Europe.
For us here in Switzerland, there is no sign of inflation. And the reason is the strength of the Swiss franc. Most of inflation here in Switzerland is coming through imported prices. And in fact, here is where the Swiss franc is playing the big role. As we have seen a stronger and stronger Swiss franc, the prices of foreign goods have just continued falling here in Switzerland. So this is explaining why the Swiss National Bank has taken its central bank rates all the way down to zero, again, at the same time as everybody else is talking about inflation. But to your point, Youssef, I think that we have to really distinguish between what's the impact of U.S. tariffs on U.S. inflation, as opposed to what's the impact of U.S. tariffs on other people's inflation. And these things may be very, very different. Actually, it could be deflationary, as it is for us here in Switzerland now.
I mean, let me pick up on that point. So the Swiss franc has strengthened dramatically so far this year. We look at the charts. Gains of 12% against the US dollar, for example. That's not something the Swiss government or the Swiss National Bank, for that matter, celebrates, because it makes exports to other countries very, very expensive. Are we at a stage where we could see an intervention?
Well, these are delicate times, Youssef, because we are in the midst of a negotiation with the US. And fortunately, we are now out of the woods in terms of foreign exchange manipulation, which is always a risk, right? When you are doing interventions, you can quickly get into a place where the US is fingering you out as a currency manipulator. So I feel that the bar for currency interventions by the Swiss National Bank in this current context is pretty high. But for sure, the Swiss National Bank, if confronted with continued appreciation pressure on the Swiss franc, if it was to materialize in very short time, which makes it difficult for Swiss export companies then to react to it, then it could envisage, for example, negative interest rates.
I mean, during COVID-19 safe haven demand, right, the Swiss National Bank, the SNB, spent 110 billion Swiss francs to counter franc appreciation, which was the largest annual FX intervention in years. But you're saying we're not there yet because of sort of the delicate nature of the political negotiations with the United States. But is there a certain level, sort of either against the euro or against the dollar, where you starting to get alarmed that now we're getting more likely than less likely?
Well, as far as currency interventions, but also risk of negative interest rate is concerned, I feel that the biggest thing to keep watch of is whether other central banks are going to have their rates converge all the way down to Swiss levels. You see, this has been the big thing during the COVID period, is that everybody else slashed their interest rates all the way to zero. And then there was no interest rate differential left between any other country and Switzerland. And then the Swiss franc gets under huge appreciation pressure. So this is the moment when there is this convergence of foreign rates down to the Swiss level. This is when really alarm bells are starting to flash.
I mean, Switzerland is home to some of the most famous companies on the planet, right? So Roche and Novartis and Swatch, ABB, Holcim. I mean, which sector are you most confident in as an opportunity for those looking at a way to, let's say, add new elements to their core portfolio?
Look, if you're really speaking specifically about the Swiss market, right now, I think that generally speaking, the Swiss market has lagged all the other markets for reasons that are well understandable. I mean, this is a market that is concentrated in a few names and then has also very big sector exposures. So there's the pharmaceuticals and the financials, which are having really the dominant weights in the index here in Switzerland. So if there is a little bit of a clearance there, in particular in terms of tariffs altogether, but then specifically on pharmaceutical tariffs, if there is a compromise, and there's just no other way around that in a negotiation between the US and Switzerland, then I feel that the index altogether could be finally in a position where it can catch up with the other markets, which have done better than Switzerland since the beginning of the year. We have to always also be reminded that here in Switzerland, when the Swiss franc is appreciating, then the performance of the market in local currency, in Swiss francs, tends to be a bit more muted, because obviously the currency is doing part of the job for international investors here.
And we'll break that down in a bit more detail. A reminder for everybody watching that we're going to reveal Nanette's other conviction views, including on Bitcoin and some of the biggest investment opportunities. So make sure you watch all the way to the end. Nanette, you're maintaining a core risk-on stature in portfolios. Is that correct?
Yes, but I have to say we've reduced it, Youssef. We've taken off a little bit of risk out of the investment strategy. The way we implement that is that we've reduced the allocations to developed market equities, specifically because we feel that now, in terms of the commercial relations, in terms of tariffs, there's going to be a period that is going to raise uncertainty again. So it's a difference between the 90 days pause, which was giving us a clear level, if you like, to work with, and now the next 3 weeks until 1st of August, where we'll still be going back and forth in terms of news flow and so forth. But then also we have to say the rebound since Liberation Day was really impressive, so much so that sentiment got extended, that also we've really seen too much too fast. And so developed markets is where we've shaved off a little bit of risk, but we have maintained our emerging market equity overweight. And we are feeling that emerging market equities are not only having more headroom by way of valuations as compared to developed markets, but then also what we have observed on the earnings trends has been really encouraging. And we have had positive surprises on China economically.
I mean, I look at a chart here from NVIDIA and crossing the $4 trillion milestone. I mean, it's an unfathomable figure. Has this become sort of a typical example of an overhyped, overvalued play on AI? And is that why you've kind of reduced risk a little bit because of names like that and how much they've come and how far they've come?
For sure, the tech sector and certain names are playing a very big role in the valuations altogether of the U.S. equity market. And if there is something that we don't like about the U.S. equity market, it's precisely it's expensive, right? So, but there are so many good reasons why these companies are valued that way. They're just having high quality revenues, and specifically speaking about technology stocks and the technology sector altogether. And I'm also including more broadly communication services as well. There, we are really seeing a structural investment theme here. Actually, among our 6 long-term convictions in equity investing, rethinking technology in light of what we have cracked by way of artificial intelligence, namely having solutions at much lower cost, which are going to accelerate its adoption in so many more companies and services in particular, is just a great development that investors will enjoy and take benefit from over months, if not years.
I mean, I wonder then whether the opportunity is sort of in mainland Europe. We have a new leadership in Germany. I mean, it's still too early to understand if a real turnaround is realistic for much of the German industry. I fully appreciate that. But your early assessment of how things have unfolded, especially given the performance of the German benchmark index, the DAX.
The German equity market has been surprising in its strengths this year after what was already a very decent 2024. It's not as if it's been lagging here anything by too much. So definitely a very impressive rally year to date, but it's narrowly distributed on names as well as on sectors. And if you look at the earnings trends, there have been downward revisions on so many sectors of the German index that somehow you cannot get too complacent with those German equities as well after such a performance in just half of a year. I mean, we have to be clear about it. What we've done here in German equities is already more than what would be a great annual performance. And so these are always moments where one has to be practical, especially when you're looking towards a period now of increased uncertainty. I mean, let's consider this for a moment. There is 24% of revenue exposure in the DAX to US, right? And so
is it 24%? Wow.
24%. This is higher than the average European. And now let me contrast that with, let's say, the Italian or the Spanish equity market, which are more domestic oriented. The exposure to the US by way of revenues of the companies that are in the index is 8 to 11%. So you can see here double the exposure of some of these domestic markets. And so if there is any negative surprise there that by 1st of August, actually, EMU is not coming to find a compromise with the United States, and some of these tariffs become effective starting August 1st, then the DAX is among those indices that are just most exposed. And I think that the comments by Friedrich Merz, the Chancellor of Germany, in terms of the importance of these US tariffs from a German economic perspective, really echo what I've just said. The sensitivity of the German economy, of the German index, is high towards commerce with the US.
I mean, when I listen to your insights, what stands out to me is that maybe, just maybe, the European Central Bank is not a significant player for the remainder of this year and going into next year between the Fed and between some of the core earnings fundamentals and drivers of European economic momentum. So it doesn't really matter what the ECB, not matter as much. I'll caveat that, right? So that, whether or not the ECB surprises slightly or is more aggressive, I mean, what would it take for the European Central Bank to really make an impact going forward? I mean, everything's already priced in. I'm wondering where your thinking is on this story.
I'd like to take a step back and just share something that I've been really quite outspoken and passionate.
I'm all ears, please.
Even if media don't like to hear that very much. But I feel that central banks are now not so much in the driving seat as they used to be since the great financial crisis. I mean, think about it. After the great financial crisis, it was all about central banks. They were really the rainmakers on financial markets. And I think that politics and politicians have made the big comeback, and that central bankers are now reacting to some of the political decisions that are being taken elsewhere. So that's just a caveat. And now let's come to speak about the ECB. The ECB, I think, yes, is going to lower interest rates. We think that the terminal rate's probably going to be somewhere at around 1.5%. It tells you, Youssef, that from 1.5 to 0%, there's still a lot of room. I mean, the ECB has firing power if it wants to, but of course, it's also stuck in a place where it has to look at what inflation is doing. And I would just say the following. Right now, I'm really focusing on what bond yields are doing, because I do think that in the...
So these are the benchmark German government bonds, right? For those who are not doing this day to day, right? So what are you specifically watching then with those instruments?
So I am watching how they are developing now over the next few weeks in long maturities. For example, Youssef, looking at 30-year German government bond yields, because I feel that if there is some disappointment by way of no accord between the US and the European Monetary Union, it is actually more expenses, fiscal expenses, that we ought to be expecting in order to support and help some of these very exposed economies like Germany to weather the tariff shock. And so very long-term yields on government debt, on government bonds in Germany, are likely to immediately price that risk of increased public expenses, increased budget deficits, and rising public debt in Germany. So certainly that's an area that I will be paying a lot of attention to, and it's a long-winded way of answering your question. I think the firing power will increasingly be with the public expenses, with fiscal policy.
No, I love how you've laid out your view in so much detail and clarity. To take it a step further, is the next domino to fall then, if sort of beyond the German government bonds, so that would also reflect in the euro trade, right? So wouldn't that lead to a weakening of the euro if the bond yields are moving and the fiscal outlook becomes? I mean, obviously this is a downside scenario. This is not the base case of I recognize that, But in that, in such a situation, euro would weaken, right?
Well, here's the response against what? Because euro dollar, you look at what the trend in the dollar is by way of fiscal expenses. With the bill that was passed through Congress, we are stuck with budget deficits between 6.5 and 7% for probably not only this year, but also next year and even going into 2027. And so against the US, we've been looking very long-term equilibrium values that seem reasonable for the euro dollar exchange rates. We are coming to something between 115 and 120. And so the euro is about where it should be. And if both of these these economies are going to have a deteriorating fiscal position, well, there may not be much that is going to happen in terms of the euro dollar exchange rate. Now contrast that with the euro against the Swiss franc. Here in Switzerland, we are not having the same debt issues than we are having in Europe. And so we could very well see the euro continuing to lose against the Swiss franc. So the point is always against what?
Yeah, I take your point. And, especially with what's happening in the United States and sort of the deterioration of fiscal credibility, let me put it that way, which is a very eloquent way to put it, to say the least. To everybody watching, we would love to hear from you. Drop a comment below, join the conversation. Also take a moment to hit that like button and tell YouTube that this content is worth recommending. I would really appreciate it. I want to turn to UK equities. And I have to say, it's been a while since I've spoken about stocks in the UK, especially the FTSE 100. And the occasion today being that, they've outperformed major European indices. But I believe they're pretty much at a record or very close to a new record high with a strong showing in energy, mining, and defense. What are you telling clients about the opportunity in the UK today? Are you taking specific bets on the UK, or are you saying it more in a broader European context?
I have to say, Youssef, we've been since the beginning of the year really shying away having any sort of regional preference because we find that things can happen so quickly. Let's talk about tariffs. The UK was one of the first to have a clarity in terms of the tariffs that are going to apply now for some time from the United States with the UK. And so this has certainly cleared the path, in comparison to EMU equities for UK companies. But then take a look at the domestic side of the UK economy, and it's not an area that is particularly encouraging. So you're down to really analyzing what's the UK market made of. And the financial sector is important. And you mentioned it. It's one of the European indices where the energy sector is playing a big role. So if we are going to have geopolitical events that drive the energy prices, oil prices up again, that helps UK equities relatively more than any other European market. And so at the moment, we have not expressed neither a positive view nor a negative view versus the rest of developed market equities on the UK.
I mean, you briefly mentioned the geopolitics, and maybe that's another thing I'd like you to sort of share revelations on, and specifically around unexpected escalation. It's hard to plan for that, of course, but you've had the Iran-Israel war, you had Gaza, you had Syria. I mean, who knows what's going to happen in the Middle East? Then you've got sort of China, the tensions with the US. You've got Russia, Ukraine. Now the US is saying they're going to send additional important military equipment. So just when we were thinking that things are going to calm down on that side of Europe, things are looking like they're heating up again. How are geopolitics getting factored into your asset allocation outlook? How are you and your team sort of finding the right way to make sure that you're accounting for that?
Yeah, it's good that you're framing it that way, because we have refrained putting up a cross-asset strategy on the basis of a geopolitical analysis. This can be very dangerous because, as you mentioned it, today the geopolitical situation is X, and the next day it's Y, something else. And so having an investment strategy then built on some expectation that the next morning is another one is very tough. So we don't do a multi-asset strategy that is based on a certain expectation of geopolitics, but risk management of making sure that a strategy and a portfolio of investments is resilient to any sort of risks that are of geopolitical nature is very well top of mind for us. So, for example, it means that we really want to be sure that we have diversifying elements in the investment strategy. I give an example with commodities and with gold. We have really tactically worked our gold positions in order to factor the relative attractiveness of gold to other assets. For example, for some time, we dialed down during the 90 days pause of the tariffs. We dialed down gradually our exposure to gold because we found that in equities, the relative value was much more compelling. But now that equities have really done this strong rally, gold has become for us, again, a good entry point to have that in the strategy for any unforeseen events. So this is what I mean, making a portfolio robust, making sure that we have elements in the strategy that are working.
On your gold note, do you have a specific price target then, or not as a house or you as a person?
Yeah, well, we've been of the view that gold is now in this new level, between 3,100, 3,300. This is where it's going to be priced.
Because, it's intimidating for somebody to step into an investment at record highs, right? So this applies to everything in general. It feels like you're coming in at the worst point, but you're saying gold at this price is actually attractive because at minimum, it's going to stay. And then if some of these other variables deteriorate, then gold could gain quite a bit.
Yes, I think that it's always dangerous, Youssef, to look at an investment in the rear mirror. To say, oh my goodness, now we are at highs, maybe multiple year highs, and therefore shying away. I mean, that's one view. The historical view is one way of evaluating the price of an asset. But then what is really important is from now and looking into the future, how's that asset valued against other assets? And that is a very important complement. And when you find that the asset is expensive compared to equities or compared to fixed income, then I agree with you. It should be intimidating, and you should be maybe a little bit cautious by way of entry point. But when actually gold has not sold back, has not sold off very much, but it's not done the same type of rally, and so against equities, it's now looking reasonable. So it should also be, the hurdle should not be too high for investors to then do what is the right thing in a portfolio, making sure that we have enough diversifiers in a portfolio in anticipation of a period of higher volatility.
And this is then, do you buy the physical gold and store it, or is it like the ETF sort of bullion backed? Obviously, if somebody wanted to put in sizable amounts, it's going to be hard to get it all in sort of physical gold, right?
Well, that all depends on private client preferences. That I'm dealing predominantly with private investors. And of course, if you're going to speak with a central bank from countries that are currently in in a difficult relation with the United States. There are going to be some very different considerations here. So there is a place for both physical gold as well as paper gold, so ETFs. What is very convenient for private investors is obviously the paper gold and ETFs around gold. I think that just simply the underlying asset is really what is very key, and I would definitely see the place for both of them to play their role in investments as well as in, by the way, central bank reserves.
Speaking of alternatives, you wrote an article in January, and it was entitled Bitcoin Handle with Care. Is your team still of the view that Bitcoin has no role in a strategic asset allocation?
Look, this is really nearly a generational question. I'm, meeting enough people of different generations to know that the younger generation absolutely has a place for crypto assets and for Bitcoin in their own allocations. What the point of our paper was really to highlight some of how to handle that, even if we, for example, don't advise it in the type of portfolios we are building for our clients, because of the specific reason that the volatility of that asset is so outsized. It is just simply surpassing anything else, that our volatility budgets would look very, very different. And that is sometimes a complex issue to deal with private investors. If a private investor is accustomed to a balanced strategy that is having altogether over their portfolio volatility between 7 and 11%, if suddenly you're telling them that the strategy, because it includes Bitcoin or any other crypto asset, is now having a volatility that is up to twice as much, depending on what the crypto asset is replacing, then this is a different beast in terms of the portfolio. And we wanted to make clear what are some of the dials that investors should be aware of when they're handling an asset that can have growth phases. So we've seen a great growth phase of
now record highs, right? And a lot has matured for the asset class since you wrote the article in January. Obviously, the Trump administration has sort of pushed the Genius Act and is pushing other legislation to try and create the right framework for it. What would it take for you to give a green light on this? It's not really the regulation or the legislation, but from what you're saying, it's the volatility, right? That's the deal breaker. Yeah.
Yes, it's really the volatility. It's completely outsized. I mean, you put that on a chart, you have most of the asset classes here, and then you have Bitcoin here somewhere in terms of volatility. So that is changing the nature of a portfolio and an investment strategy in a very meaningful way. If you're going to tell me that the regulation is going to have an impact on the volatility, and I've been studying that volatility enough to see that, over time, the volatility is slightly decreasing. So even 5 years ago, the volatility was even higher than what it is now. But is it ever going to converge to volatilities that we have on other asset classes? I don't think so. And regardless of how the institutional framework is facilitated by better regulation. So I'm with you that the growth of this year has been really helped by the facilitation of the institutional framework, of the broadening use of crypto assets. But I tell you, the day there is going to be again an increase of central bank rates for whatever reason, this is an asset that is very sensitive to where is the opportunity cost. And interest rates, central bank rates, are opportunity costs for assets that are not giving any interest rates. That's gold, that's crypto assets too.
With that being said, you have been following the technical price action. Investors have poured in $2.7 billion into a group of Bitcoin ETFs last week, which was one of the largest net inflows since their debut in January of last year. Where do you go from here in terms of momentum, right? When you look at the charts and the technical indicators that you are especially fond of?
Yeah, I have to say I'm always following different ways of looking at financial markets. You mentioned momentum and technical analysis is looking very much at patterns and recognizing any patterns. So I do pay attention to them, but then these are also the things that cannot capture catalysts for changes. So it's one part of the equation that I take a look at, and there may be still some upside here, especially because in the U.S. the Federal Reserve has paused interest rate cuts, and we were expecting them to restart with those interest rate cuts when they get better clarity on what is inflation doing in the US in response to those tariffs and some of the other measures, deregulation, how services inflation is doing, and so forth. And that is all helping assets that where interest rates are the opportunity cost of them. But then I'm also really focused on just simply the volatility of this and anything that can catalyze the reverse. Because, we have had significant instances where this asset has also been shedding a lot of value in very short time as well. This is the whole point about outsized volatility, is that these things can happen very quickly in big sizes.
The view or the hope was that this asset class has now sort of entered a new phase, to be determined and to be seen in practice, right? But the idea being that with larger flows and more institutional capital, even at the margin, that it's going to, bring at least bring the volatility more in line with what you'd see on an S&P 500 or a NASDAQ, for example, right? So that's going to be the big question to answer for me in the next 6 to 12 months in terms of understanding how the dynamics are changing so fast. When it comes to the U.S. Federal Reserve, then you're expecting them to shift the policy stance from restrictive to neutral. In terms of recession, no recession, I mean, it looks pretty clear that we're in the no recession camp, right?
Certainly, at Lombard Odier, we've held that view even at these darkest times around the 2nd of April, where actually the financial market and equity markets were pricing a recession. And the reasons why we've been more sanguine was that we've always thought about those tariffs the way Donald Trump was approaching them, as a transactional means. In other words, a leverage to get out to somewhere else in terms of international relations, commercial relations, and so forth. So we've not been so worried about those tariffs coming to the full effect of the announcements. Nevertheless, there was also some very good areas of comfort in the U.S. economy relating to the U.S. consumer. Youssef, that the U.S. is largely dependent on U.S. private consumers. And so if these are having jobs, if the labor market is stable enough for them to continue to afford their consumption expenses, and if some important categories of goods like energy, for example, is seeing prices come down or not increase, then actually we are having some very good ground here to not expect a recession.
The bigger question maybe is whether or not Jay Powell, the Fed chair, is going to see out his term, or will you think that political interference is going to take hold of the Fed and obviously cause a roller coaster of repricing and everything from sort of bonds to stocks? Do you have a view on who the next Fed chair is on top of that?
Look, institutions are very important for financial markets, and definitely central bank independence is an institutional framework that financial markets take a lot of solace from. So should there be any preterm development here of Jerome Powell leaving the Fed, I think that this would have an impact, a negative impact on the confidence that financial markets are giving to any sort of outlook. So there is going to be a risk premium that is going to be immediately priced relating to that sort of influence on institutional frameworks. Now, with respect to the succession, really, even if it is just the conventional succession after the end of the term of Jerome Powell in 2026, we are going to pay great attention whether this is going to be a reasonable Fed chair or Fed chair that has had and has been on the record with less reasonable ideas. And so, yeah, the chairmanship is absolutely a critical policy-making position that financial markets are paying a great attention to.
I want to get to a bit of a personal segment now, Nanette. What inspired you to get into finance?
Well, I love economics. I love financial markets. It's a passion. So I felt this was the best place to work at. And it feels that when I go daily to my occupation, it feels like so exciting. And so, yeah, this is what motivated me.
Was Lombard Odier always going to be the natural next step after Credit Suisse?
I think that really I was looking towards an institution that is that was having this partnership, which is a very different way of running a company than a universal bank, where especially we have seen several teams of management at Credit Suisse. So I was very much looking forward to this more stable, long-term strategic way of running a business. And then what I really have been looking forward to is the quality of relations. Increasingly on financial markets, when you are dealing with private investors, what has always impressed me is companies that are able to have a relation with their customer that is such a high quality relation. That makes the difference. And yes, it's a natural step.
Where were you? I wanted to ask, I've been meaning to ask you this for a long time. Where were you on the day when I interviewed the chairman of the Saudi National Bank and his comments shook up the world of finance? What do you remember from that day?
Yes, it was a very hard day because Youssef, I couldn't tell you where I was. I mean, where I was when on the Friday before the announcements of what was going to be the future of Credit Suisse. I was in Geneva then, but prior to that, I've been following, like every employee of Credit Suisse, every twist and turn, and obviously these comments that were also, I think, misinterpreted by so many people were really worrying, and this is what I can remember of it.
Who would you say is the greatest investor of all time when you look back at all your your research and the work you've done and the ideas that you've reflected in? Can you tell us who comes to mind when you think about somebody who should be in like the Hall of Fame? It can be somebody from way in the past, or it can be somebody today.
I'm not going to surprise you. I have a lot of admiration for Warren Buffett. I think that together with Charlie Munger, they really epitomized what are people who also from their personalities are the right kind of investors. An investor actually needs to be modest to be very successful. And I therefore have had so much interest in them because this is how they keep investing at repetition in things that are really multiplying their and their investors' money. It's through the modesty and through the absolute discipline and groundedness. They have always been grounded investors. So yeah, I have a lot of admiration for them, for this discipline and for managing to stay modest in spite of their huge success.
I mean, for those starting out on their investing journey, what would be sort of a big piece of advice you could give them? Put it in an S&P 500 and forget about it?
Well, it's interesting you're telling me that, because I speak a lot with the new generation myself. I have 2 grown-up children, and both of them are making their first dabbles into investments as well. And yes, my advice to them is always to invest with this long term and not shy away from risk. So this is something I speak a lot to my daughter. And then also my son has already made the experience that trading is not investing, and that actually over time his investments that we're taking, the more long-term approach, were those that were most gratifying. So yeah, this is what I'd certainly, as an investor, I would say it's important to not shy away from risk. It's also something that I speak a lot to women investors, private investors that are not financial specialists, who sometimes feel a little bit intimidated by equities and the volatility and the uncertainty and the lack of control. I mean, as an investor, you cannot control financial markets or your investments. So that is sometimes really impressing upon investors that are not from the area, but there it pays off to have some risk that you can tolerate over time. This is paying off. And then also not to be trading too much, because in the end, unless you have some particular insights, you spend a lot of time doing all these extraordinary analysis that very famous investors are doing. Well, one time it's going to be running well, and the other time it won't. And then on average, you're not going to do much better. So you've spent a lot of time for not doing much better than a well-diversified portfolio.
Yeah, I mean, I can attest to that. Sort of the first few tries at sort of financial markets, and inevitably you think you can outsmart the market, and then you get lucky a little bit, but then you get kind of whacked by reality against your position. And I think that is unfortunately the way most people learn. Sort of the significant scale and just the disproportionate size of some of these bets that are being made. But again, with all that being said, how do you stay motivated, Nanette? Closing question, and what are your hobbies like?
Oh, I take a lot of motivation from having a balanced activity. I like and I'm passionate about financial markets, but there are many other things I like doing too, and I want to have the time to do those as well. So I'm a keen sailor. I take a lot of groundedness, being out at sea and not seeing anyone and just having to deal according to different laws, the laws of nature, and that makes me always resource and come back full of energy.
Nanette, this has been a very energetic discussion. So thank you very much for indulging the program, and all the best for the remainder of the year. And I look forward to catching up in Zurich very, very soon. Thank you again.
My pleasure. Thank you, Youssef.
Thank you for listening to You're in Business. If you've enjoyed the conversation, like, share, and subscribe. See you next time.